6th October till Dharmesh Kant is with us. Welcome Dharmesh to Business Today Television. It's such a pleasure to welcome to you on Market Today. Tell me, how are you looking at the broader markets since you actively track the banking sector with such instance and rigor? What are the charts telling you, and what is the prognosis for the next 4 days?
Yeah, good morning. See, Cheryl, how the market has panned out, the macro front, everything has been shaping up pretty well. If you look at the core sector growth numbers, they were very rock solid. At the same time, the cement numbers, Ultratech reported a very strong volume growth, and that was expected because August was a dry spell, so that is helping out. At the same time, the tax collection number has been very strong. So all the fundamental macro data points are pointing to a very strong set of Q2 numbers. When the corporates roll out their numbers, it's likely to beat what the analyst is expecting. At the same time, global headwinds, though it's an indecisive global headwind which is playing out, because the talk about US recession has not panned out so far, and it's the data point which is coming out from US in spite of the historic interest rate is very strong. So what is seen across the board in economies, the relevant economies which is driving the world economy as of now, is a uptick in the strong macroeconomic data point fundamentally. So what we are focusing on is the core economy. The cyclical ones like metals, infrastructure, cement, automobiles. These are the sectors which should be in the spot for a trending drift on the buy position. And as you said, financials, I think this time again, financials are going to surprise the street on the NIMS and the ROA front, because last quarter the expectation was the NIMS is going to contract. But that did not happen because of the 2000 notes were rolled back into the system, and that led to a good CASA and lower cost of fund. This time around, again, most of the banks have passed on a higher interest rate to the consumer. So the short-term lending rate has gone up, and that will take care of the NIMs again. And the trade growth would be around 15 to 17% on an average for the industry. So there again, the surprises will be there. The sector which is in for re-rating is the banking space, and it's likely, public sector banking space is likely to be so. So again, the outperformance will come from public sector banking space as compared to the private sector banking space. That is the relative outperformance I'm talking about. And the stock ideas out there, I think Canara Bank remains a topic from the public sector banking space on all metrics, be it valuation or the upside momentum which we can see. And when it gets related to the likes of SBI or Bank of Baroda, around 20-25% kind of an upside can still be there. So these are the sectors and spaces where we are specifically looking for good momentum opportunities. And for the day, one can go with Canara Bank.
Fine, that's a good point that you make, and of course the traction that we've seen in Canara Bank has been phenomenal. Let me just share some data with you. For the past week, Canara Bank was of course down 1.2%, but this has been one of the star performers as far as the current rally is concerned, both in the PSU banking sector and of course in the mid-cap index as well. The Canara Bank is up about 26% in the past quarter, and if you look at the one-year performance, well, it's a fantastic 65% rally. The dip that you saw last week is what Dharmesh advises you to buy. The all-time high on the counter is at a fair distance away, and at the moment at 376 rupees in front of you. It's the highest since December of 2017, so that would make it a 6-year high, and the highest level that you've seen is 821 rupees. So a lot of upside still left, and given the strength that we are seeing in the banking sector balance sheet, as also the growth in the economy, corporate lenders such as Canara Bank should have a good time over the next 18 odd months. Dharmesh, the other point I wanted to ask you is how are you dealing with the demands of ultra HNIs who see a very, very strong traction coming in mid caps? If you look at last week's performance, the Russell 2000 was the biggest loser in the US markets, which of course represents the small cap and the mid cap space on Wall Street. We haven't seen that kind of a correction come in as far as Indian mid caps and small caps are concerned, but it's only a matter of time.
Yeah, I mean, the correction may not come in India in the middle and small cap space, but the relative outperformance of the price action is what we are doubting as of now. And as you rightly pointed out, if you look at Russell 2000, it's up only 1% year till date. So, in fact, in US, if you strip Nasdaq out, so Dow Jones is up 1% and Russell is around 1.3% year till date. So, there has not been any action out there. Back from our side of the market, so what we have done, we have proprietary indexes we have built up on a market capitalization basis. So there, what we have found is market cap in excess of 200 to 500 rank wise. They have done phenomenally well, and that is where the slowdown is happening. If you look at price to earnings multiple, they all are trading at near to +1 standard deviation, and that is where the correction sets in. It can be a time bound correction or a price correction. What we are expecting is a time bound correction to happen there. As far as ultra HNIs are concerned, they are holding on to their mid and small cap bets, which they have taken. None of them has is still talking about liquidation or profit taking. What they are specifically concerned about is the earnings trajectory. They are willing to wait for a year or so. So that, I mean, sentiments have already, sink in that one has to wait for time for this to have a next leg of a better price appreciation. So they are holding on to this, but what they are asking for is more of a traction into large cap space and the immediate mid cap. I mean, rank wise, if you say from 50 to 200 market cap. So that is the area where I think the most of the traction is going to come. And there we are focusing more on the infra space, railway stocks, and construction, I said infra, and at the same time some banking space. So public sector banks we already discussed. That is one area which is looking exceedingly well. And the other area where I think still there is a lot of buying opportunity and good price action can happen is the railway stocks. For example, RVNL. RVNL or IRCON, if you look at it, they are still undervalued compared to the type of growth trajectory they have impact on around 25% kind of growth plus 23% kind of an ROE, and forward multiples are still 21 to 19. So such kind of a stocks do get related to 30, 32 kind of a PE multiple. So 40, 50% kind of a upside is still there. So RVNL, if one can buy for even for 1 year perspective, I think 220, 230 should be the price target coming out there. And that is where on every dips accumulation is being seen, but it's in a staggered fashion. Now that gung-ho kind of putting all at one go is not happening. And that I think is the right strategy to take forward in this market.
Gramesh, coming to you. Your pick, please. NTPC or Grasim? What would you prefer?
So I would say NTPC because power sector is more of a growth sector as of now, and going with the way the renewable energy addition is likely to happen in next 5-6 years, around 100 gigawatt each year is the target. So that opens up a very big space for all the power sector plays, be it NTPC, JSW Energy, Tata Power, or Power Grid. So what we have now advocating with the type of run-up which we have seen in all the power stocks is like a basket approach kind of a thing with a equal weight kind of an allocation and keep on adding on all the dips. So it's a good long-term play for next, say, 3 to 5 year kind of a time horizon if somebody is having. They are doublers from here because the capacity additions each one will be having will be almost they all will be doubling the capacity in next 5 years time frame. At the same time, the ROEs are going to be maintained in operating leverage as well as the operating margins will be much better going forward because the type of price stability we have seen in electricity and the consumption is 10-12% kind of a growth. So this all augurs well. Grassing why I would like to avoid is because of the diversified kind of a portfolio they are setting on, and they foray into the paint division. One has to see how it pans out eventually and how it leads to the market share gain and the operating margin front. So it's a more of a holding company I would avoid rather than I would go with Ultratech Cement from the same group. For the cement play, paint is a play we would like to avoid given the current kind of a scenario and the heavy competition which is coming in. You can say the same for the cement sector, but cement sector the volume growth is far higher than that in the paint segment.
For worry,
I think this trend of recent correction is likely to continue further, and for this to be a healthier correction, market should go to 19,200 or 18,500. That is where we are penciling it for this correction to get over. And that is where we would be advising for aggressive buying. So, because at 18,500, you are trading at 1 year forward PE multiple of around 18 times on the Nifty earnings. So, 17.5 to 18 is where the mean lies, and that is where the comfort zone is there. So, but this morning data, I thought that market may surprise you because going by the core sectors number and the type of drop we have seen in crude oil prices and the tax correction. But screen is telling what you have been advocating this morning, and this selling to continue, and this is a healthy correction for any market. So aggressively, we would start, doubling at 19,200 and 18,500 onwards, we would go all out. So that is where this leg of correction should get over, according to my mind. So one should wait before, pulling on the triggers for buying.
Actually moving into the defensive. Dharmesh, anything that catches your interest? Maybe Marico?
See, with the type of, eventually the monsoon panned out almost near the normal, though it was 1.5% below the long-term LP of 96%. But nonetheless, the swing has been good, and all the FMCG stocks are primarily the business comes from the rural and semi-urban areas. So that side is now taken care of. I think with the type of correction which we have seen in most of the stocks from last, if you look at 1.5 months, like Hindustan Lever or Dower. So Dower is one stock which attracts my attention. Marico today has been doing well, and the numbers were good for the last quarter, so it's likely to do well going forward as well. But in pecking order, I would like to go with Dower first, and then maybe a Marico or an ITC. So these are the three counters where one can build into position. I would still avoid, for example, Nestle or Hindustan Lever.